One of the interesting things that's happened with this sort of explosion of factor investing, and especially in the ETF landscape, is that the way we talk about markets has changed. I mean, any of us here in describing recent movements could probably say what value, what growth, what momentum is doing. So with that in mind, I want to talk about the sell-off we've seen the past couple of days, because certainly I have seen a lot of commentary on what factors are doing. So Lars, I want to start with you. What have you seen over these past couple of days when it comes to factors, and could factor investors be driving it specifically?
Well, I think the key thing you've seen, and you saw that yesterday in the trading session in the US, was the huge dispersion you got between value and growth, or value and momentum. If I look at the magnitude of the dispersion, it's certainly a 3 standard deviation event. So that's something which happens probably every 3 or 4 years. Now, if you just look at statistics, ETFs is a good way now to start investing in that spread which you got. But if you look at the longer term, then factors as such, or factor investing as such, I'm not the biggest fan of it, but I'll probably tell you that afterwards.
Yeah, we can definitely get to that. But sort of sticking with today, Lorraine, what have you seen clients been doing around the trading that we've seen over the past couple of days, especially when it comes to smart beta ETFs?
Since the beginning of the week, we have seen some flows on low vol, without surprise, and some flow also on value, which is more a surprise, because usually it's pro-cyclical factors, meaning that you buy it when you believe in the market. So it was quite counterintuitive. That's the kind of flow we have seen. Yeah.
Right. Vitaly, does that surprise you that we're seeing people move into value these past couple of days?
Actually, I don't find it all that surprising, because so value generally has not been doing all that great over the last 10 years. And as a result, what we see is value stocks trade quite cheap relative to growth stocks. And if you move outside of US and to emerging markets, for example, that spread is as wide as it's ever been. So it should not be all that surprising that when people see risk, they go for stuff that is cheaper and can provide a little bit more protection. And the things that have been experiencing healthy flows over the last several years, they may feel a little bit more risky.
At the same time, though, I mean, Vitaly, what you're saying, Lorraine, what you're saying, they're both true. Neither of you are wrong. Lars, can you help me sort of bridge this gap? I mean, how can, or anyone, how do we see this?
I fully agree with Vitaly. There is like a mean reversion on the value factors. It's already so cheap now that you have to buy it, because you are expecting mean reversion. So I agree with Vitaly totally.
But I mean, does those flows last? Is that sustainable? Because to your point, I mean, you have to believe in the market, you have to believe in global growth for value to really take off.
It depends how you consider factors investing. We are considering at long-term premia, so we are not believing in market timing. So I'm not maybe the right person for the question, because we don't believe you can make money timing the factors on the short term.
Okay.
Perhaps if I could just intervene here. What we used to have in the past, we used to have factor rotations, and we used a model which was the cycle clock, and that kind of gave you a fairly good idea when you would have rotation and over which period of time, roughly. But these models stopped working. In fact, they stopped working, I would say, in 2011, 2012. And to your point, yes, in fact, you should have been into value, according to the models, for a long time, but value has massively underperformed. If I look at the discrepancy between value and growth over the last 5 years, it's a 40% difference. So that means if you're stuck into a specific factor, it can cost you dearly. And therefore, trying to time factors, I think probably it might be because of the distortions which we had because of quantitative easing. Maybe that's why the models didn't work. But we're not sure about that. And that's why it's very difficult to stick to one specific factor. And the way we are doing it, we are taking various factors and trying then to collect the different risk premiums.
Vitaly, I mean, what's your sort of view on this factor timing issue?
We believe, let's separate two things. First, what is evidence on factor timing, and second, what can you do with it? There is evidence that, well, the strongest evidence that factors exhibit momentum in a short period of time. So like on a monthly horizon, there's very strong momentum. So if momentum factor or quality factor is doing poorly this month, it's much more likely to do poorly next month too. And then there is very strong mean reversion, mean reversion happens at longer frequencies. It takes longer horizons to benefit from it, and you have to be really, really patient to benefit from it, and the evidence for it is weaker. So having said all that, can you benefit from explicit factor timing? I'd say it's very hard to do so. You need to do to have a lot of discipline to rebalance and to kind of be able to not do it too aggressively. So it's hard. With having said that, many of the marketplace are market timers. They're just doing it in the wrong direction. So many investors are buying quality stocks after they've been doing great over the last 10 years. The same goes for low beta stocks. So, just avoiding that tendency of trend chasing can actually improve the return.
I mean, after all, this is a ETF panel, but you're saying you shouldn't. It's hard to trade but you're tempted to by the very fact that it's in an ETF wrapper. Lorraine, is this problematic? Is this something that issuers have gotten greedy by putting them out? BNP, of course, withstanding, but putting them out in an ETF wrapper. I mean, is this the right sort of place for smart beta to exist?
Yeah, definitely for monofactors, because you can use it tactically. Even if we don't believe in market timing, but you can use it to maybe correct a bias in your portfolio. You are too much exposed to growth, so you can put quality, for example, or value if you want to balance a bit. You can use it in plenty of ways on diversification. It adds one dimension. You have a sectorial diversification. You have geographical diversification. With a factor, you get factorial diversification. The excess return of the factors are quite decorrelated, so exposing a low correlation between them. So putting that in your portfolio, you decrease the concentration of your portfolio. So it can be used like that. And to have monofactors in ETF, it makes sense. Regarding multifactors, you are using it. We do it more in index funds because we think that it's not fair to make the investor pay a bit of a spread on ETF. And it's more buy and hold position because you enter and you have to wait like 1 year, 2 years, 3 years, it may be longer to get the return.
Yeah,
it's a buy and hold. So.
Right, definitely some patience required. I mean, Lars, how do you see? I mean, are you guys interested in multi-factor ETFs, or is it still more on the index side that you would prefer to buy that?
No, definitely multi-factor. But what I would say is, I do not think that the ETF is the right vehicle. In fact,
sorry, is this for all smart beta or
for factor?
Okay.
Yeah. In fact, what I think is usually the reason why you kind of buying factors is because you need to be patient, right? To your point, right? Now, the problem again, if you focus only on one factor and you need to wait 10 years for that to crystallize, then you probably lose all your clients, right? So you can't underperform for too long. So that's why multi-factor, I think, is important. But as a vehicle, I think an index fund is much more appropriate than an ETF, because why do you need the intraday liquidity? Maybe yesterday or today you would need it because you have, like, as I said, a 3 standard deviation event where you could kind of react very, very quickly because you had a big discrepancy. So statistically it makes sense. But usually over time, I mean, you buy into a factor, you invest into a factor because it's a specific style. And the style, you use it through a multitude of months and years. And therefore, the intraday liquidity, or the premium you pay for intraday liquidity, is in fact a premium which you do not need in portfolio construction.
And Vitaly, I mean, you guys certainly advise and have built indexes that ETFs are made off of. So what sort of is the value proposition of having it in the ETF wrapper?
in different markets, the value proposition is different. So in the United States, there is obvious benefit of tax advantages that ETF as a wrapper brings, and so that's not to be sneezed on. In Europe, here I would say that well, we as a firm don't have products in every geography in ETF format. So I would agree that probably ETFs here tend to be somewhat more expensive than other types of vehicles, and they can provide a little bit too much of incentives for this high-frequency trading, and it's not what you should be doing. In fact, with factor investing, you should be paying attention to costs both in terms of fees and in terms of trading costs. So shaving off those is very important. Then going beyond that, you should be patient. What we've found and what research has found is that investors tend to lose about 200 basis points per annum from rotating between different funds, from selling after the funds have been doing poorly, and buying things that have been doing greatly. So this trend chasing results in buying expensive assets and selling cheap assets, and that results in a return drag. So if you could move to buy and hold, that's going to improve your long-term performance. And then finally, Three Sigma event, is this actually something that should be very rare or not? Well, actually, we've just put out an article talking about risks of factor investing, and what we found is that factors tend to have quite frequent tail events. So the return distribution of factors is far from normal. And what it means is you should get ready and you should be expecting these tail events if you want to benefit from factor investing. It's common to have, we should be expecting, let's say, if the investment horizon is 50 years, to have maybe a quarter of a century for factors like value to be under the benchmark. For multi-factor, there's quite a bit of diversification benefit, but you should expect maybe a decade out of these 50 years to be under the benchmark. And so that's, if you're not prepared for that ride, that maybe going for a traditional cap-weighted benchmark is the right way to invest.
Lorraine, I mean, what do you see? Do most investors, do they have the patience? Are they starting to learn, or are they pretty sophisticated and know that it's going to take a decade to see any sort of alpha play out?
The first thing is that to select ETF, a factors ETF, it's quite a long process because it's like a true due diligence of the methodology, because there is different methodology between all the providers. So once they have done this work, they tend to stick to their investments. So I agree, maybe the ETF is not the best way because they stay like for 1 year, 2 years, or 3 years, and they should have done it through index fund maybe. But some of our clients can do only ETF, like ETF fund of fund or robo-advisor, so they are asking for the liquidity of the ETF, even if they don't use it most of the time.
So how big of a problem, Lars, when you're sort of evaluating different factor funds, the way that they're built? I mean, do you have a hard time when it's deciding between all the various, value funds that are out there? Is that a really difficult problem for investors right now?
No, because usually it's very transparent. So I mean, what I like with the factor funds is they're rule-based.
Right.
So therefore, you know exactly how they constructed, you know how they're rebalanced, and it's extremely transparent. Having said that, if you use the name value, for instance, you will see that many people have different understandings of what value is. And therefore, I think it's very important as an investor then not to buy any value ETF or value index fund, but really to look what's under the bonnet. How is it built? And you will see that there's big discrepancies in terms of value products or value ETFs.
Right. So on that point, I actually want to bring up a chart. It's on value funds and sort of their purity of what they're investing. So I can describe what the chart is. So basically, if you break down the categories of flows, it's down there for you guys. If you break down the category of flows into either sort of watered down value, middle of the road, or pure. So pure being you're getting exactly that value exposure. Maybe it's long short with use of swaps. Watered down being it's market cap weighted with just sort of a tilt to value. And since, Lars, you brought it up, if I can pick on you, are most investors doing it wrong here, that they're going to water down? So again, this is going to be sort of more market cap weighted, but just tilted towards value. Lorraine, do you think that this is a mistake for most investors?
No, I don't think so. You have, as you said, Lars, to really do a strong work on the methodology. At BNP Paribas, for example, we are using descriptors. We have tests, so several descriptors for value, for example. We're trying to mix them to get a pure alpha. We try also to work on a sectorial neutral basis. So we are looking for value stocks in each sectors, meaning that we don't have over bias on sectors. For example, on low vol, we are exposed on utilities, we are exposed on healthcare. Who are traditionally sectors with low volatility, but we are also exposed on technology, on telecom. So it means the alpha of the risk factors is really pure. So we try to avoid to be on the watered down and to be more on the pure side.
Right.
To have really pure alpha.
Okay. Does this make sense, Vitaly, for most providers, for most ETF users to go towards the pure side versus the watered down side?
It does. And let me make an analogy where I think the difference in these vehicles is like difference between motorcycle and let's say train. Motorcycle, yes, it's a very nice, nimble vehicle, and you can, if you know what you're doing, you can ride quite fast from one place to another. But a tube is going to be cheaper and much more reliable, and if you don't know how to use it, it will not hurt you. That's why most people prefer tube versus motorcycle. So there is a market for motorcycle buyers for pure factor investing. If you know what you're doing, you want that very clean factor exposure, go for it. But majority of the people prefer the transparent, simple, understandable, and probably cheaper vehicles.
So I want to, in the spirit of motorcycles, I want to switch gears a little bit. Sorry. We could probably have an entire panel about this, but I just definitely want to touch on it as we're sort of getting to the end here and talk about fixed income factors. Lars, is this a godsend? Is this a fad? What do you make of buying fixed income factor products?
No, well, first of all, I think you can also apply what you have in the equity space to fixed income. For instance, if you want to have a specific credit quality, if you want to have a specific duration range, that you could do. Where I have problems is when it applies to the credit markets and especially high yield. In fact, I personally think that, and you might disagree with me, but I personally think that an asset class which is potentially illiquid and which probably has become very liquid because of QE, and now QE is starting to be removed, that asset class shouldn't be reflected via ETFs. And if I look at the type of investors on the advisory side now who have been flocking into that asset class via ETFs, that is quite frightening. And I'm surprised that the regulator hasn't started to move in.
So what would the consequences be that frighten you about that?
Well, once QE is removed and once markets become less liquid, well, then people will start to understand that they have something which is potentially less liquid. And once it's less liquid, I think many investors who think because it's in an ETF, it is liquid, they will all run through the door, and suddenly you have huge spreads. And I think that's a risk which many investors, especially on the retail side, do not understand yet.
Yeah. How does BNP sort of approach some of these, not just fixed income, but specifically like factor fixed income that might be a little bit harder to get the liquidity necessary?
Yeah, no, we agree with Lars because we don't do factors, fixed income factors ETF. We do funds, which are 99% systematic and 1% judgmental, because we still need to have the PM to say if he can invest on which day, today, tomorrow, maybe it will be better. So we need a PM on that. And it's for liquidity issue, even now when the market is not so in stress. So I agree. I imagine when there is a big drop in liquidity, it's going to be a nightmare for purely systematic strategies. That's why we don't do it.
Right, Vitaly?
I totally agree with the previous points. Plus, if you think about what has made factor investing appealing in the equity space, it's been quite a big dispersion in fees between passive and active funds. And where active funds, for instance, trade on average at 100 basis points, many passive funds trade at sub 20, sub 10 basis points. And so that spread moved quite a bit to the adoption of smart beta funds. Now, in the fixed income side, the fees are much smaller to begin with. That's one. And second, beyond the liquidity concerns, which are very meaningful, I would say active managers have an advantage in fixed income illiquid markets where they can go for specific issuances, can they provide liquidity and can essentially make the market that way. They can generate extra alpha that way. And that is very hard to systematize and offer in simple, transparent vehicles.
Right. Then why are we seeing so many of these pop up? I mean, Lars, we continue to see new launches of factor fixed income ETFs. Why do they exist if they're so problematic?
Well, to take a famous quote, because the music hasn't stopped yet. And the music might be stopping, and especially in the credit space. Again, high yield ETFs, I think it's dangerous. I think there's probably a bubble, especially in Europe. In fact, we've tried to save the system, and we solved some problems, but we created some other problems. And the other problems is there are too many investors now who do not really know high yield. They've never invested in high yield in the past, and they're doing that via vehicles which they think are very liquid. Again, until the music stops.
Right. I mean, do you see that coming soon as we're sort of getting some pullback on?
Well, look, in the US, we are already starting to remove quantitative easing. In fact, we've started that a few months ago, right? So it hasn't bitten yet. We are still in a global environment which is supportive. If you look at absolute interest rates, they continue to be very low. If you look at QE on a global basis, we are still in a QE environment. We started to do quantitative tightening in the US, but the Bank of Japan and the European, the ECB is still in QE mode. But that water is receding, and once that support is gone, then it's going to be then you will see who's swimming naked.